Good afternoon, everyone. Thank you for joining us today for our annual year-end payroll and information reporting seminar. Before we begin, I just have a couple of housekeeping items to go over. Today's seminar is eligible for 3 CPE credits. In order to receive those credits, you must be active for the full duration of the seminar. And additionally, we will be sharing 3 poll questions per credit hour, which will be 9 poll questions total. And those will appear unannounced on your screen throughout the presentation. You must answer all 9 of these poll questions in order to receive CPE credit. Each poll question will only be up on your screen for about 30 seconds. While that poll question is up, you will not be able to see the PowerPoint presentation, but just know that the slides will come back on your screen as soon as the poll question is closed. Everyone is muted, so please use the chat box on your screen to submit any questions. We do have a Q&A session scheduled in the middle of the presentation before our 10-minute break, and then a final Q&A session at the end. So please feel free to submit your questions as you have them. And then lastly, you can download PDF files of the booklet and PowerPoint slides through the GoToWebinar panel on your screen under Handouts. We will also be sending out a link to access the booklet, slides, and a recording of this seminar on our website by the end of this week. Thank you again for joining us. I will now turn things over to Joe Cawley to introduce our presenters and agenda.
Thank you, Kayla. Good afternoon, everyone. Welcome to the Brown-Schultz year-end payroll and information reporting seminar. My name's Joe Cawley. I'm a tax principal here with Brown-Schultz. I'm going to co-present along with 5 other team members. Sherry Cracium-Bolin will be presenting along with Kay Toth, LuEllen Martin, Abbie Cawood, and Karen MacDonald. We've got a good presentation for you. We do encourage you to ask questions into the chat, and we will do our best to get to those throughout the presentation. But we look forward to spending the next 3 hours with you, and by all means, ask questions if there's a topic you have a question on. So with that, I'm going to kick off the presentation on page 4 of the handout materials, and I'm going to talk about the employee retention credit. What we want to talk about here, this program's been around now, came out right after COVID in early 2021. Was modified several times to broaden the credit and to add a second year for taxpayers that would otherwise be eligible. A lot of you on the presentation today, a lot of those companies have taken advantage of the ERC and have made application, filed the amended returns, and got the appropriate refunds. However, the program is still available. The 2020 tax year will expire under the statute of limitations on or about March 15th of 2024. And for C corporations, April 15th of 2024. And the 2021 tax credit will expire in March 15 of 2025 and April 15th of 2025. So there's still time under the statute of limitations to make application for it. If you're not sure that you are eligible for the credit, we do encourage you to contact either myself or the tax service principal that you work with, because the opportunity is worth taking a look at just to make sure. So for the 2020 credit, it was for 100 eligible employees. For 2021, they expanded it to 500 employees. So Some of you may have thought you weren't eligible based on 2020, but we do encourage you to take a second look. You are seeing a lot of media advertisements for the ERC credit, either on the radio, on TV. So there is still a lot of activity with the ERC credit, and the government has not lost sight of that. There's currently a moratorium on those credits applications just for the IRS to get some procedures in place to look for fraudulent or credit applications that are suspicious. But nonetheless, it is still available and worth taking a look at. So any questions that you have with respect to the ERC credit, we do encourage you to contact us and have that conversation, probably a 10-minute conversation. We'll be able to figure it out, and you'll know with certainty whether you're eligible or not for the ERC credit. So with that, I will turn the presentation over to Abbie, and we'll get started on the rest of the materials. Thank you.
Thank you, Joe. Welcome to the year-end payroll seminar. We're going to start off with our payroll reporting on sick pay. To determine sick pay, you will look to the coverage period to see whether sick pay is considered taxable. And you'll determine that by the payments made during the first 6 months, beginning after the month in which the sickness or disability occurred. Those are considered taxable wages. Payments made after 6 months following the disability, even if earned during the first 6-month period, are non-taxable. Those would be typically your long-term disability applicants. A keynote is if the employee returns to work even for 1 day, your coverage period is going to start over again. When third parties pay the employee, they will typically remit the FICA/Medicare employee taxes. The employer will then remit the employer share of FICA, Medicare taxes, and FUTA and SUTA if applicable. So you'll want to make sure that you are receiving from your third party timely the pay schedule so that you know what FICA taxes to remit and to remit that timely. It's also very important to clarify with the third party who is filing the employee W-2 for the sick wages, as this will lead to how the 941 returns should be filed. So again, sometimes it's not clear, and it's best to just pick up the phone and call your third party and just verify who is reporting what, so you know on the 941 if you are just showing the FICA tax for your portion, or if you need to include that in wages so your W-3 will reconcile. The form 8922 needs to be filed by the employer if the third party is reporting the employee's sick wages on a W-2 under the name and EIN of the agent or the insurer. So again, if you don't need to report those wages on your piece of the W-2, then you will need to file the form 8922. And this form is due at the end of February, so it gives you a little bit of time after your W-2s are filed to report that. And now we will turn over for LuEllen to talk about the W-4.
Good afternoon, everybody. I'm going to go over the W-4 form and the I-9 form. You can find this information in the book on page 16. For the W-4, there are no new updates for 2023 and 2024. The last revision was made in 2020 due to the new law. Instead of claiming allowances, the form provides the employer with information needed to determine the amount of income tax to withhold for the employee. Employees do not need to complete a new form each year if they don't have any withholding changes and they did not mark the form as exempt. In order for an employee to mark exempt on the form, they would need to qualify under the following two situations. They received a refund of all federal taxes withheld in the prior year because they had no tax liability, and they expect the same thing to happen in the current year. Employees who complete the form as exempt will need to submit a new W-4 every year. To assist employees with completing the form, you can refer them to the IRS withholding estimator to help them determine the amount of income tax to withhold. This estimator is both available in English and Spanish, and we provided the link for that estimator on the slide as well as in the book on page 16. If an employer does not receive a completed W form from the employee by the first payroll, the employer will need to withhold the federal taxes at the higher rate, which is single. An employer can reject W-4 if it is incomplete, altered, or they know that the false information was provided. If you reject it, then you need to revert back to holding them at the single rate until you get a completed form. The form needs to be retained by the employer for at least 4 years after the date the taxes were due or paid, whichever date is later. For terminated employees, you need to retain the form for at least 1 year from the date of termination. You can keep the W-4 forms in paper or electronic format. Now for the I-9. All U.S. employers must complete and retain an I-9 form for every individual they hire for employment in the United States. This includes citizens and non-citizens. The employer must examine the employment eligibility and identity documents an employee presents to determine whether the documents appear to be genuine and relate to that individual. This information is then recorded on the I-9 form. The list of acceptable documents can be found on page 2 of the form, and we do have the revised form and the new instructions on pages 172 through 183 in the book. Employers need to ensure that the employee completes section 1 of the I-9 no later than the first day of employment, and the employer fully completes section 2 of the form within 3 business days of the first day of work. U.S. Citizenship and Immigration Services released the revised form on August 1st, and it became effective November 1st, 2023. All employers are required to use this updated form going forward. Some of the changes in the revision are they replaced the word alien, is now non-citizen on the form. It is now formatted for completion on tablets and mobile phones using Adobe. Sections 1 and 2 have been reduced to now fit on one single page. The instructions have been overhauled and have been reduced from 15 pages to 8 pages. And as I previously said, we have the revised form in the back of the book on pages 172 through 183. Employers who are enrolled in E-Verify can now remotely examine employee I-9 documents that way. You do not need to complete an I-9 form for persons who were hired on or before November 6, 1986, who are continuing in their employment and always have a reasonable expectation of that employment. Anybody employed for casual domestic work and private home on a sporadic, irregular, or intimate basis does not need to complete an I-9. Independent contractors do not need to complete one. Providing labor to you are employees of a contracting who are providing a contract services do not need to do an I-9 for your company. And anybody that's not physically working on the U.S. soil does not need to complete one. The I-9 form is filed with the USCIS or ICE. It's not filed with them. This form must be kept by the employer for as long as the individual works for the employer. Once an employee is terminated, the form I-9 must be kept for either 3 years after the date of hire or for 1 year after employment is terminated, whichever is later. The form can be retained on paper, microfilm, or electronically. And this must be available for inspection by authorized U.S. government officials such as Department of Homeland Security, Department of Labor, or Department of Justice. Employers should maintain all employees' I-9 separately from all other employee personnel documents. That way, in the event of an audit, you only have to provide the I-9. And I'm going to lastly talk about some best practices for employee files and how you should keep them. Employers should maintain employee documents in 2 separate places depending on the type of document it is. The 2 categories include, and you can also find this information on page 18 of the booklet. Category 1 is pre-employment documentation such as job descriptions, resumes, offer letters, reference checks, emergency contacts, and acknowledgement or receipts of agreements and the like. It also includes employment documentation such as job performance promotions, disciplinary actions or warnings, compensation changes, awards, changes to their specific payroll and tax information such as direct deposit forms, formal trainings, attendance, or tardy records. And lastly, part of category 1 is separation documents, which includes exit interviews, separation checklists or agreements, resignation letter, and any other corresponding items. In category 2, it includes all medical related forms such as doctor notes, FMLA, and other leave requests, results of drug tests, COBRA information, and benefit enrollment forms. And last for category 2 is any background or credit check results that you receive. I'm going to now turn it back over to Abbie.
Thank you, LuEllen. I'm going to discuss the non-payroll income tax withholding. This is in reference to 116 in your booklet. The Form 945 was created to report the federal income tax withheld on any non-payroll tax payments. These payments are typically for retirement plan distributions and backup withholding from 1099 information returns. So if you might be experiencing this if you've ever received the dreaded B notice for your 1099s. Federal withholding can be remitted via EFTPS, just like you remit your federal tax deposits for the 941, the 940, the 943. You would just select 945 and the appropriate tax year to remit that federal tax deposit. For years that you do not have federal income tax liability, you do not need to file a 945 return. The IRS isn't anticipating it, so you would not receive a notice for non-filing if there is no tax due. Form 945 is an annual return, just like the 940, and it's due at the end of January. If you have paid in full all of your tax deposits and remitted timely, they do grant you a small extension, and you would have, for this coming year, it'll be February 12th, the 2023 945 return. The rules for tax deposit filing frequency remittance are as follows and are separate from the payroll tax deposit rules. Monthly depositors, it's $50,000 or less of federal tax liability in your look-back period. Semi-weekly deposits, it's greater than $50,000 in your look-back period. And there's still the one-day deposit rule, just like for your payroll taxes, of if it's $100,000 or more in your tax liability, you need to remit that the following day. The look-back period is determined by using the second calendar year preceding the current calendar year. For example, 2024's look-back period will be 2022. 2023's look-back period will be 2021. The penalties for untimely payments are similar to your payroll tax deposit rules. And then for PA, the law requirements for withholding on non-income tax is still at the 3.07%. On non-wage PA source income payments, made to non-PA residents for payments that are $5,000 or more during the calendar year. If you do not have a PA withholding account number already, if you do not file payroll with PA, you can register for the PA 100 through MyPath if you need to file the 1099s, and they will grant you a withholding account number. And you would also need to file, if there's 10 or more, you will need to file those electronically. And you need to make those payments electronically as well. And I will switch it back over to LuEllen to talk about federal.
The Electronic Federal Tax Payment System, EFTPS, is mandatory to make electronic payments of all federal tax deposits, payroll taxes, excise tax, income tax payments. The only exemptions are deposits that can be made with tax returns, such as deposits for employment taxes that are under $2,500 that can be made with a quarterly Form 941 or with the annual Form 940. If you are required to use EFTPS and you do not transmit funds electronically, a 10% penalty will be assessed on the amount of each deposit. Payments made are direct with either ACH debit or ACH credit through a financial institution. Some of the convenience of this system is that you can schedule payments up to 365 days in advance, which is good. If you want to set up your estimated tax payments ahead, you can set that up to automatically come out on the due dates. You can make tax payments 24/7. Easiest way to pay your income, employment, estimated, and excise federal taxes is electronically. You can easily change or cancel scheduled payments at least 2 business days before the scheduled date. And you can also go back and view your history for up to 15 months. Effective October 19th, 2023, EFTPS added a secure login step. Some of you may have already been through this process, but I will go through the steps for those of you who haven't. The first time you try to log into EFTPS, you will be redirected to a separate page and prompted to register with a credential service provider, either login.gov or ID.me. There is a third option called PIV/CAC. This is the option that federal employees and contractors use. You will be prompted to register and or authenticate with either login.gov or ID.me. To register, you will need to provide an email address, create a password, and add a cell phone number to receive a code either by text or phone call. Upon completion of this step, you will be redirected back to EFTPS to input your EIN, PIN, and password. The difference between login.gov and ID.me is that ID.me is not a government entity, so it's just, whatever your preference is. They both work pretty much the same way. You can also find this information in your book on page 49 and 50. I will now turn this back over to Abbie to go over Pennsylvania.
Thank you, LuEllen. We will start discussing all things specific for Pennsylvania, and then we will switch over to Maryland. The 2024 Pennsylvania with wage limits and withholdings, there are no changes this year except for Social Security. Social Security has jumped 5.2% from 2023 to 2024. That's another large jump, just like last year. The new Social Security threshold is $168,600. It was $160,200 in 2023. You will see there's no changes for Medicare, state income tax, or local income tax, for wage limits or the percentages. They're all remaining the same. PA unemployment has stopped with their 10,000 limit for employers, but the employee portion, there is still no limit. You will also notice It started this year in 2023, but they unveiled it pretty late for PA unemployment, that it is up to that 0.07%. In 2022, it was the 0.06% for employees. PA does not have a credit reduction due with the 2023 940 form. They did not last year, even though there was discussion that there might be. So the only states that will probably face the credit reduction are California, Connecticut, Illinois, and New York. They already had a 0.3% credit reduction for 2022, and they face a credit reduction of up to 0.6% for 2023. Pennsylvania new hire reporting, you will need to report this for all new hires within 20 days of the hiring date, as well as rehires. We have the link here, and it's also on the booklet on page 67. I recommend that you do it electronically. It's a lot easier than the form. There are two ways to do it on the website. You can either do it manually with up to 3 employees, or you can set up an account so it will save all of your employer information, and you can just continue to log in and remit timely your new hires. Employers need to report these new hires and rehired workers to the state for them to cross-match open child support cases, locate non-custodial parents who change jobs frequently, and to reduce fraudulent overpayments in state benefit programs, such as unemployment and workers' compensation programs. And PA employers would report all employees who reside or work in PA to the PA new hire reporting system. So again, all employees that work in PA or live in PA, you would report there. The electronic funds transfer for PA, all state tax payments of $1,000 or more need to be paid electronically, and those can be remitted through the new site MyPath. Approved payment methods are ACH debit, ACH credit, certified or cashier's checks that are hand delivered, or credit/debit cards. There is a 3% penalty assessed with a maximum of $500 for non-compliance. And as well, the mandatory electronic payment threshold for unemployment is if the total liability owed equals or exceeds $5,000 per payment period. It's important to note that once this threshold is met, all subsequent payments must also be remitted electronically. So even if your next payment is less than the $5,000, you're still required to make that payment electronically. And failure to comply with this would require that the requirement would result in a 10% penalty based on the face value of the payment, which is a maximum of $500. Payments for unemployment can be made electronically through the UCMS website. PA unclaimed property. This you need to report after 2 years any uncashed payroll checks. I recommend if this employee is still working for you that you ask them to cash the check. If it's too old, have them reissue it. Even if it's an employee that is no longer with you, if you have contact information, you can attempt to reissue this paycheck to them before you remit it for unclaimed property. That's probably the easiest solution for you, or have it direct deposit. You're writing off dormant accounts into income does not negate the obligation to report and to deliver unclaimed property. So you cannot use any creative accounting. You need to be reporting all your accounts payable checks as well. They are deemed abandoned. All the reports now need to be completed electronically. The holder reporting record keeping system was updated in June of 2021. So if you previously had an account set up before that, you will need to register for new account login under the new system. And if you're trying to clean up your books, you can request an early remittance, but the property still must be at least a year old before it's approved. So if it's within a year, you can still request to get that cleaned up. You'll see on the slide here and in your booklet on page 67, the link to patreasury.gov where it will give you instructions and the login information to remit these electronically. And now we'll switch over to Karen for Maryland.
Good afternoon. I'm Karen MacDonald. Work primarily out of the Westminster office. So I work with a lot of Maryland clients, although I do have a few who are in Pennsylvania and then some who are in many states. But I'm going to talk about Maryland this afternoon. So this slide looks very similar to the one that Abbie went over with the 2024 wage limits. All the federal limits are the same as they are if you have an employee in Pennsylvania. So your Social Security wage limit has increased from the $160,200 in 2023 to $168,600 in 2024. Medicare and the state income tax, there are no changes. However, the county portion of the state income tax, the rates have not been issued by the state of Maryland yet. We do have a link in the booklet to those county rates. It's on the Maryland tax facts page, and they normally are issued mid-December. So that's when you would be able to update any county rates for the state of Maryland for Maryland employees. The federal unemployment, as Abbie said, there are no changes in that. The Maryland unemployment, there are no changes in the wage limit. It's still based on $8,500 of earnings. There is no employee portion like there is in Pennsylvania. The employer rates are typically issued mid-January, which can sometimes make it a challenge if you've already prepared payroll, but they are issued and you can find them on the Maryland Beacon website. So I recommend that typically if you are filing your fourth quarter Maryland unemployment return, when you're in the Beacon website, you will hopefully be able to see what your new rate is for 2024 and then update whatever payroll software you have so that you can be accruing the correct amount. Returns for the Maryland unemployment are filed on that Beacon website, and payments can be done on the website electronically. If you prefer, you can print a voucher and mail in a paper check, but using the electronic transfer system is much better, as sometimes those paper checks are not remitted timely and can cause issues. The Maryland local tax, which I talked about already, is each of the counties has a separate rate, and so the range of rates for 2023 was 2.25% to 3.2% based on the county, or Baltimore City has its own separate rate. It's based on where the employee lives, so that whatever the county rate is gets added to the state rate, and that becomes your combined tax rate for the state of Maryland. As I said, those rates for 2024 should be posted on the Maryland's website in mid-December. They have remained fairly steady in the past few years. So you may not notice any difference, but it is a good idea to update it each year. When you file the W-2s at year end, the state portion and the local portion is added together. And it isn't on two separate lines as it was a number of years ago. The state will take care of distributing the amount that goes to the county on their side. And then you can see the website here. This is the 2024 withholding tax facts. That is where you will find what those county rates are and any updates that the state might have for 2024 in mid-December. Electronic funds transfer for Maryland. For years, we have been using the B-file system, and that can be used for filing and paying employer withholding, sales and use tax, and you can also use that system for submitting W-2s electronically. We just in the last week have had several team members who've been in CPE and have received information that in February 2024, there is going to be a new system, a new website coming out called Maryland Tax Connect. And that is supposed to be replacing the B-file system. We don't have much information, and if you look for it online, search for it, you're not going to find it. They do have on their website, they do have a place where you can sign up to receive email notification of the information when it comes available. And of course, BSSF will also be putting out information as soon as we have more information on that new website. Maryland new hire, similar to the Pennsylvania new hire, you need to report new hires or rehires within 20 days of the hiring date. You can do that either on their website, or you can fill out a form and fax it in. Similar to Pennsylvania, if you do it online, you can set up a login and then all your employer information will be there. So then all you have to do is fill in the employee portion of the information. The forms and more information on that are on pages 82 and 83 in the booklet. And as Abbie said, the main reason for the new hire reporting is so that the states can work with child support agencies so that those who need to have that garnishment are notified, to their employers are notified of that information. The Maryland Saves program. Just before we did our seminar last year, this program was started. It was introduced in September of 2022 based on legislation from the state where they wanted to make some type of a retirement savings available to every employee who works in the state of Maryland. The system is not designed to replace any retirement program that the employer already has. Therefore, there is a waiver for employers who do have a retirement plan. So the retirement savings is set up as a Roth IRA, so it's not pre-tax, but it is a savings plan. There is no employer match required, and there's no fees incurred by the employer to administer the plan like there is with other retirement plans. If the employer does have employees who participate, you will need to report the withholdings and submit the withholdings to the Maryland Saves program. One of the ways that they are trying to help with compliance of employers either setting up accounts or affirming their exemption is that those who have an account set up or registered their exemption by December 1st of each year have a waiver of their Maryland personal property tax annual filing fee. So you would save that $300. As I said, the employers do have to recertify their exemption each year in order to receive the waiver of the Maryland personal property filing fee. So there are two different methods of being exempt from participating in the Maryland Saves program. The one is if you do have an existing retirement plan, whether that be simple IRA, 401k, 403b, that's the one exemption. The other is if you have a totally non-automated payroll system. So if you still use books to look at tax tables, to find out tax withholdings, and do everything by hand, do not use a computer at all, that is considered a non-automated payroll system, and you can receive an exemption and still have a waiver of the Maryland personal property fee. So the registration process, which this has been a little bit confusing, but we have more information this year than we did last year. In order to register, you will need an access code that is provided by the Maryland Saves program. You'll need your EIN and you'll need your Maryland personal property SDAT number. We have found a number of employers did not receive the access code. And so we do have a phone number, and that is available on pages 89 and 90 in the booklet. There's more information, but we did provide the phone number where you can call them and provide your EIN, the company name, and your SDAT number, and they will provide the access code. After you do the registration, you need to have those three pieces of information, and you put the employer information in. Then you will need to provide a list of employees with their information, social security number, date of birth, contact information, etc. Once they have that information, then Maryland Saves will reach out to the employees. And they typically do that via email. And the employees will then have up to 30 days to either opt in or opt out of the system. So it is totally up to the employees whether they want any type of retirement withholding. The employer will then be notified by Maryland Saves of whatever the employee's decision is. And that decision will also show up in the Maryland Saves login for the employer. Once you have employees participating, when you process payroll, you will need to take the deduction, and as I said, it's not pre-tax, so it's just reported as a post-tax deduction. So that has to be reported on the Maryland Saves website for each employee. And then the payment, the preferred method is for the payment to be debited from the employer's bank account. They do allow for you to submit a check, but again, their preferred payment method is a debit from the employer bank account. And then the other thing that employers need to be doing is updating their employee list with new hires, as well as reporting terminated employees. So if you are participating in the Maryland Saves program, which is if you are an automated payroll system and you don't have a separate retirement plan, you need to be participating in the Maryland Saves program. Once they have your employee list, you need to keep that updated and then process any deductions and payments into the plan on behalf of your employees. I have two websites here on the slide as well as in the books. The MarylandSaves.com is most of the information that employers as well as employees will want to see. The information. It has the program information, the guidelines, there's fact sheets, frequently asked questions, all sorts of good information on that website. The MarylandSaves.org is the website where you will go to do your initial registration as an employer, or it's also where you would go to do your exemption certification, which again, as I mentioned, you have to do that on an annual basis in order to receive the $300 filing fee exemption. And that filing fee exemption is, we worked with a number of clients last year, and it automatically goes through and is reported to SSTAT. So it does reimburse you at least for some of your troubles. The other new thing in the state of Maryland is the paid family and medical leave. This is a new program that they have been working on for several years, but it is going to be in full swing in 2024. There are a number of states, I think it started back during COVID, a number of states started providing family and medical leave programs, and Maryland studied it and they have come up with a plan. So they do have a website, which I have listed at the bottom of the page here. There's also some information on page 91 in the booklet. So this system was put in place, as I said, in 2023 by Maryland Department of Labor. Their plan is that in early 2024, they are going to be publishing the rules and regulations. And then on October 1st of 2024, the deductions and contributions begin. So there are options. Employers either need to use the state plan that's offered by the Department of Labor, or they can seek approval for a private plan. The private plan would have to be as good as, have the benefits as good as what the state is providing, and it can't cost any more than what the state is providing. And you do have to get approval for that before you can not participate in the state plan. So the state plan, as I said, the contributions and deductions are to begin on October 1st of 2024. The rate is 0.90% of covered wages, and it's to be divided equally between the employee deduction and an employer paid portion. However, employers do have a right to choose to cover part or all of their employees' contributions. Also, employers with 14 or fewer employees are not required to contribute the employer portion, but they would still need to collect and remit the employee deductions. So the employee deduction is non-negotiable, but the employer portion, if you are 14 or fewer employees, you have an option of not contributing to that. So the contributions will begin in the fall of 2024, and they will start issuing the benefits in January of 2026. And as I said, this is a very new plan. Their webpage is very helpful, has the whole timeline and all the information there. And you can sign up for more information and emails on their website as well. And the last thing I'll be talking about is the unclaimed property laws in the state of Maryland. As Abbie said, in Pennsylvania, the unclaimed laws, property laws, it's very similar for the state of Maryland. So it's after 3 years, uncashed checks, whether they be payroll or vendor checks, are considered abandoned property. So as Abbie recommended, if you have contact with the employee or the vendor, the best method is to reissue the check or ask them, if the check is out of date, or have them cash the check. Notice has to be sent to the recipient between 30 and 100 days prior to returning the funds to the state of Maryland. And then if you don't receive a response from the recipient, then they have to be reported and funds transferred to the state. If you have more than 10 items to report, it has to be submitted online. If it's less than 10 items, you can use paper forms, which we do have copies of those in the back of the book. You can also see the Maryland's website, which we have the link there on the bottom of the screen, for more instructions on reporting.
All right, thank you, Karen. Also, thank you to Abbie and LuEllen for presenting that payroll information to us. We're going to shift gears a little bit here and talk about some state and local issues with employees, and specifically what we're going to be talking about is remote employees for the most part, and what state and local tax issues would come from that type of arrangement. So with your remote employees, and this is primarily an outgrowth from COVID-19, what a lot of companies figured out during that time was that they could have remote employees working. They didn't have to be physically on site at the location of the employer itself. So when this initially happened, a lot of states came out and said, if you have remote employees, we will treat those employees as if they are employed and working from the employer location. Now that we're removed from that about a year and a half, the states are beginning to look at that differently. So what you need to be aware of is what are the state and local tax issues of having remote employees. When we're just dealing with in-state remote employees, so if you had a Pennsylvania employer with Pennsylvania-based remote employees, Some of the issues you have to be aware of is, does that relationship now create a nexus connection, and nexus being a physical presence of your employee in a location that is different from the employer's location. So within Pennsylvania, you could have employees working in Philadelphia, for instance, or Pittsburgh. Those two cities have business privilege tax, net profits taxes that your employees could expose the employer to those additional compliance matters with those types of employees. In addition, you could have employees working outside of Pennsylvania. And when you have employees outside of Pennsylvania, you're now opening the company up to exposure from a multi-state filing standpoint to state and local taxes that you have never been exposed to before. What you have to be concerned about is sales and use taxes in states where you have remote employees. Again, business privilege taxes, looking at corporate income taxes is also an exposure, especially for states that have minimum taxes that they assess on taxpayers. And a lot of states outside of Pennsylvania, when you do register for payroll taxes to report and remit those payroll taxes, they will search the databases within those states for compliance with other state and local taxes that might apply. So some of those other tax situations will be sales and use tax, corporate net income tax, and business privilege taxes in cities and localities. So we want to bring that to your attention. This can, as we go forward and these arrangements continue to expand, it probably is a good idea to have a conversation with your tax service providers to make sure all of the various state and local tax situations are being discussed. There is a multi-state tax commission where they have what's referred to as a factor presence test. And I'm going to have Sherry speak to that. She's joining me in this part of the materials. And we don't have anything in your book other than the screens that we're showing you. So if you're trying to find this in your booklet, it's not in there. You're just going to have to look at our slides and listen to what we're talking about here. So Sherry, you want to jump in here?
So the Multi-State Tax Commission, want to point out these three factors that they have on here are voluntary. So the Multi-State Tax Commission is something that various different states can elect into. They're always trying to come up with some sort of standard that all of the states will accept. But to date, this is just voluntary. And you will find that now all the states that have a sales and use tax, since the Wayfair decision came down from the Supreme Court, they all have instituted some sort of economic nexus for their remote sales into their location. It used to be very brick and mortar related with the Quill decision years ago. However, since the Wayfair and the Internet of Things, as they like to refer to it as in all of the sales tax classes that I've taken, everything is so digital now. So there's a lot of state digital sales taxes and a lot of things purchased on the internet that used to be purchased in person. So economic nexus is kind of the new buzzword, and a lot of the sales, even though this slide refers to the $500,000 sales factor presence, that is something that they're trying to get across the board. Here, a lot of the states kind of go with like $100,000 in sales. You'll see that a lot of places for economic nexus. But when it comes to income tax nexus, a lot of times they'll maybe raise that up to like the $500,000 and any one of these things. So I think that big picture, just be aware if you are selling into whether it is remote sales, services provided remotely, you got to take a look at, do you have more than $50,000 in payroll with your remote employees? If you do, in a specific state, maybe you need to start looking at your sales into that state. If it starts to go over 100,000, that's when you kind of need to look at that specific state's rules to see what else might be causing you to have some nexus there. Every single state is a little different. So these are guidelines. Does not necessarily mean that every state follows them. Most have something a little bit different. So those are kind of the guidelines, and just we had a little bit of a, Joe mentioned like the different franchise taxes and various things you could, have one employee in the state of California who makes $50,000 a year, and that creates nexus in California. For franchise taxes, you could be then subject to the $800 a year franchise tax fee there, whether you make any money there or not, have sales there or not. That one employee could actually cause you to have nexus there. So every state, again, very different. These are some guidelines to follow, and when you need to maybe dig in to figure out what's causing you nexus. I will also mention that from a payroll tax perspective, almost every single state, if you have a remote employee there, you're going to have to most likely pay unemployment taxes there on their payroll. And then you have to look at reciprocal relationships that the state that you are located in for your business might have with the state that your employee is related to. So Maryland, Pennsylvania, reciprocal agreements, not as big of a deal there, but you start to go outside where you have remote workers in non-border states, or say in Pennsylvania, you have New York is a big one who really doesn't have reciprocal agreements with us in Pennsylvania. So DC and Maryland sometimes get a little bit snarky with each other. So you just have to be careful there and make sure that you're paying attention to where all your employees are located and what that does mean for you in this whole new world of remote employees.
Correct, yep. Good stuff there. And Sherry did mention, as you'll see on this slide, she talked about economic nexus, and from that Wayfair case, that bright line was drawn at $100,000 of sales into the state, where the state can make a claim for economic nexus. So again, the states will try to be as aggressive as they can be to find new revenue generators. So when you pop up on the radar screen, they begin to correspond with you, not only from a payroll standpoint, but potentially from some of the other taxes we've been talking about, income, sales, and use. Another area that the states engage in once you sort of pop up on their radar screen is they'll send you what's referred to as a nexus questionnaire. And they're asking you what type of activity you're carrying on within the state. And we would caution you on the nexus questionnaires, you really should have a conversation with your tax service provider. You could call on myself, Sherry, or any other tax service provider here at Brown Schultz. Before you respond to a nexus questionnaire, to have us take a look at it with you. It's sent out in a very non-threatening manner. They ask you the same question in 3 or 4 different ways. And, with a yes/no format, it's very easy to answer the question where you think you're answering it one way and the state is interpreting it another way. And then once the state identifies you as having a nexus connection, it's very difficult to extract yourself out of that. So the best practice would be very cautious in responding to them and make sure you're answering the questions appropriately. There's also this concept of Public Law 86-272, which has been around since 1986. Again, it's a multi-state tax commission type of interpretation. It's looking at solicitation of sales in states outside of your local area or the state where you're physically located. So again, there's been significant case law established under this public law, but it can help you in certain situations. So again, what we're trying to bring to light here is with the increase in remote employees working throughout the United States, make sure that if you are establishing a relationship with remote employees, especially outside of Pennsylvania and or Maryland, have that conversation with us to explore what could be the issues involved there. On the Pennsylvania side of things, there are some updates that were recently passed in the budget for 2023. A lot of it is around the corporate net income tax rate. The state's going to begin to reduce that in an effort to become more competitive in the economic area of enticing companies to relocate into Pennsylvania. A lot of times corporations don't want to come to Pennsylvania because it has a high corporate net income rate. And we probably have, if not the highest, among the highest corporate rates among the 50 states. So it's currently at 9.99%, or it was at the end of 22. For 2023, it will go down to 8.99%, and then it will reduce at 0.5% annually until the rate gets to 4.99% in 2031. Pennsylvania has participated in these types of phase outs with other taxes that Pennsylvania assesses. A lot of us can remember the capital stock tax. So there were a number of years that was phasing out to an elimination period, and it took multiple times to pull that off. And now it's out of the Pennsylvania tax currently, but until we get to 2031 at 4.99%, there are no givens. And depending on the state treasury from year to year could dictate where that tax rate falls in the future. From a Pennsylvania NOL standpoint, you currently get to use 40% of your net operating loss carry forward. What that means is that you will pay Pennsylvania corporate tax, even though you would possibly be exempt on the federal side, although federally it's at 80%. So going forward, you're probably going to see both a federal and a Pennsylvania tax there. Under consideration are combined reporting, as well as a pass-through entity tax, with the limitations for individuals on current, on their itemized deductions. This is potentially an opportunity to take advantage of a higher state tax deduction through the pass-through entity return. In addition, non-resident credit for pass-through entity taxes on non-residents. Partnerships currently don't have the same treatment as S-corps, so the state is looking to make that change where they're both getting the same benefit or providing the same benefit for non-resident or for Pennsylvania residents paying tax in other states. So that's what's happening there. For a Maryland update, Sherry, kick it over to you, and if you want to add anything to the Pennsylvania district.
So Joe mentioned there at the very end, some legislation that Pennsylvania is considering regarding the pass-through entity tax elections. That's been kind of thrown around there in the Pennsylvania legislation, but in Maryland was one of the very first states to pass legislation related to the pass-through entity tax election a couple years ago. And they've, tweaked this process a couple of times over the couple of years it's been in place. Again, the reason that this is put into place by many states is because for any pass-through entity owners, such as a partnership or an S corporation, those individual owners, normally they pay tax for federal and state tax purposes at the individual tax level. And then with the SALT limitations, state and local tax limitation for itemized deduction users, that was being limited to $10,000 was quite the hit on many pass-through entity business owners. So what the pass-through entity election allows you to do is to make that election, you pay the state income taxes for the business income at the business level, which allows you to take a federal income tax deduction on your federal tax return for business purposes, and therefore get that deduction still, even though you normally would have been limited otherwise on your personal tax return. So it's a pretty big deal, and it's something that a lot of states tried to work around a couple of different ways to get around that, and the IRS basically knocked down just about everything else they tried. But this actually was approved as one way to do it, and it kind of makes it puts them a little bit more equal footing with the corporations, right, for their state tax deductions. So that's the kind of background on that. It's yet to be seen if Pennsylvania will do that. Right now, it's something like 30 states that do have some sort of pass-through entity tax election. Big thing to point out that's new with Maryland's election this year is normally you would have made this election on the tax return at the end of the year when you determined when you were going to make that election. They did change the rules in early 2023 to say that with the first payment that you make for a 2023 tax year and after, you will be making the election or the non-election, and that this is irrevocable. So if you made a first quarter estimated tax payment in the past, we kind of would wait till the end of the year, see if you had income. If you guys wanted to make the election, we made the election on your business return at that time. Instead of doing it that way, you have to make the election with your payment. So if you make payments and you have non-resident and resident members, so you make those payments and you don't check the box that you're electing the PTE tax this year, those payments get applied for your non-resident withholding payments instead, and you will not be able to file an election for the PTE tax. Now, I will say if Brown-Schultz filed your return and you did make this election in 2022, your estimated tax payment coupons were automatically set up to have the election in place, so that you should be covered. They did go ahead and pass additional regulations that clarify that if you make those payments and say at the end of the year you have a loss, so therefore then you cannot file the election, the form with the election. Instead, you will file the form 510, but you will be able to receive a full refund of those payments regardless of that, if you would be in that situation at the end of the year, because you just never know. We'll say that this election I said that there's 30 some states now have one. Every single state's a little different. So if you do business in another state, some states require you to make the election up front on a website or some other way. I will say states like Virginia, you're required to make any payments electronically. You're required to do electronic extensions. There's no way around that. If you do not do it that way, they will not accept your election. So again, every state's a little different. Many states have this in place. The other thing to mention with Maryland's pass-through entity tax and Maryland in general, they have been going through a e-filing upgrade system. And Karen mentioned earlier the new business portal that'll be coming out sometime at the beginning of 2024. That is all part of their e-filing and software upgrade that's been going on in stages throughout the last several years. It actually started before COVID and has been slowly continuing. Now they threw in the pass-through entity tax election right in the middle of all of this. So if you file taxes in Maryland and you have made this PTE election, you probably have gotten some sort of tax notice from Maryland because they were not able to match up all those payments in their various systems. They are still not able to do that. They have come up with some systems to make it better, but I will tell you that we are still dealing with tax notices from 2020 and 2021, and now some from 2022. In order to get those things matched up. They provided us some good practitioners outlets to do that for our clients. So I would just encourage everybody, if you do get a notice for your individual income taxes and you own a business in Maryland, do not just blindly pay that notice. Please make sure you get that to us because that is something that is very likely wrong. And they've told us they're going to stop sending the notices out. So hopefully maybe it's a good thing that that happens. Maybe it's not, because then you won't know. But they are feverishly trying to match these things up. They have also let us know that while they are implementing all of these new systems and they're going to have the business tax portal come out the beginning of next year, you'll be able to make online tax payments that way. One of the things they're really trying to do is get you to file those PTE taxes electronically and pay them electronically. There's currently no way to pay those online. So unless you set those up through like us for direct deposit through our tax software, you're mailing checks in still, and that is very hard for them to match up. So, so they're encouraging people to do direct debit when you can. So I would encourage you to do that. It does seem like those people are getting better matching. So I encourage that. I also will caution that they will not have these two systems matching up until 2025. So we're dealing with this for probably 2 more years. So just keep that in mind as well. And then I would also mention again, in order to get ready and know when they are ready for the business online portal, the Maryland Tax Connect, go on marylandtaxes.gov, click on the link to sign up for their newsletter. Their e-newsletter is new, so if you've gotten newsletters from them in the past, if you haven't signed up for something in the last 2 months, go do that now because that's brand new. It's all connected to that new software system that they're using, which is in general is called Maryland Tax Connect. Individual portals will become available, they think, in the beginning of 2025, but they're still negotiating that with the software developer. So just a few things in the new realm coming from Maryland. So
Great. Thank you, Sherry. With that, we'll, go back one. Questions, Kayla, do we have questions from the audience?
Questions, Joe.
Okay.
The first one here is, must you update your previous I-9?
Somebody want to take it?
No.
So the question is, must you update your previous I-9s because the I-9 form has been updated effective in 2023. So LuEllen, you want to?
So you just, going forward, any new employees that you have, you need to use the new form that was revised and effective for November 1st, 2023. You do not need to go back to your current employees and do a new I-9 for them.
And then the only other question we have right now is related to the Maryland family. And the question is it 14 or fewer employees in total, or 14 or fewer employees in the state of Maryland?
That's a very good question. I would assume, but as I said, this is very brand new. I would be about 75% sure that it is your employee count in the state of Maryland, not all together, if you have multi-state employees.
Those are the only questions we have right now.
Okay, great. Everybody, we're going to get started again with the second half. The game plan here would be to talk about fringe benefits, information returns, and a couple of other related topics, and then wrap everything up by 4 o'clock. So I'm kicking off the second half on page 20 in the handout material, and we're going to talk about the COBRA continuation coverage. Again, this applies to employers who have a group health plan, and primarily employers with more than 20 employees with a group health plan. So what the requirement is under COBRA is that you as the employer provide a written notice to each covered employee, spouse, and dependents when they are eligible for coverage in your employer-sponsored plan. What that model notice of rights is going to do, it will dictate who will do what and when in terms of termination of coverage within the plan. So the employer will notify the plan administrator if there's a death of the employee, a termination or a reduction of hours, if that employee becomes eligible for Medicare, or there's a bankruptcy of the company. Again, the employer would know when those events occur. The covered employee and qualified beneficiaries, they're going to notify the plan administrator of a divorce or when a dependent child ceases to be a dependent within the terms of the plan. So that's usually at the 26-year-old mark. So again, what we're talking about here are model notice of rights in your group health plans. There is a model notice of rights in the handout material on page 146. Again, you can copy this model notice of rights right out of the booklet material to make sure you're in compliance with those rules. There is an excise tax for failure to follow those rules. That excise tax is $100 per day, up to $200 per day if there is the employee plus one or more dependents in the plan. And again, that penalty can get onerous. There are exemptions to the COBRA continuation coverage. That's for employers who may have a group health insurance plan, but they have fewer than 20 employees, a governmental plan, or a church plan. I would caution, though, for employers with 20 or fewer, there is a Pennsylvania mini COBRA Act out there that requires continuation coverage for a shorter period of time for those individuals. You can read up on that initiative on page 69 in the materials. In terms of the excise tax that I had talked about, $100 a day, $200 max. That penalty can be assessed for a period of up to 6 months after the continuation coverage period has run. That coverage period can be a minimum of 18 months to a maximum of 36 months. So if I'm adding 6 months to that, this excise penalty can add up to a significant amount. And you as the employer could be obligated to correct that failure. For a qualified beneficiary who was not offered continuation coverage, you might have to make them whole. I do here. Okay, so just to summarize, again, it's the model notice of rights. You want to check with your plan administrator or the individual at your company in charge of notifying new participants in your group health plan to make sure that you're in compliance with this. The qualifying events, again, termination or reduction of hours, divorce or legal separation, dependent children that cease to be dependents, death of an employee becomes eligible for Medicare, or a bankruptcy. So again, from an employer perspective, the two that you're concerned about is going to be a divorce or legal separation and dependent children that cease to be dependents. So keep that in mind and make sure that you're in compliance with that. So I'm going to turn it over to Mary Kay here, and she'll take us for next few slides.
Thank you, Joe. Just an update on some overtime regulations here. So the final rule, or the last update from federal, became effective on January 1st of 2020. And that's where the minimum salary threshold increased to $684 a week. And that was a pretty significant increase. It was up from $455 a week. The duties test did remain the same. There was no changes there, and you can find those duties tests starting on page 196 of your booklet. If you recall, Pennsylvania tried to enact their own overtime laws with a phase-in of a higher minimum salary threshold. It was supposed to be phased in over 3 years, but 2 years ago, that was repealed at the last minute when they tried to balance the budget. And Pennsylvania now follows federal, except for a couple things we'll talk about in a minute. One thing I did want to mention about federal is that the Department of Labor did just propose a potential increase to the minimum salary, which will most likely go to $1,059 per week starting in 2024. They did have a comment period that ended last week, so we have to keep our ears open to see what happens there, because if that is passed, Pennsylvania will have to follow that. Pennsylvania did make a couple of changes last August for tipped workers and also salaried workers who work a fluctuating work week. For tipped workers, some of the changes include employers are prohibited from deducting credit card processing fees from employees' tips. There's also the 80-20 rule, where the employer that takes a tip credit for an employee, that employee cannot spend more than 20% of their weekly hours on duties other than tipping type activities. There's also some new things about tip pooling. Now, tip pooling is not a requirement, but if you do utilize tip pooling, you need to notify the tipped workers of the arrangement. They can include both traditionally tipped and non-tipped occupations. But there are some exclusions from the tip pool, which include individuals with ownership, employees that meet the executive duties tests, and you must adhere to the 80-20% rule that I just mentioned. For fluctuating work week, this mainly is for non-exempt salaried workers. So weeks over 40 must be paid at time and 1/2. Federal says half-time rate over 40 But in Pennsylvania, you have to follow federal because it is more favorable to the employee. We do have a link on page 55 of the booklet, which is for Pennsylvania. There's a lot of useful information regarding the changes that took effect last year. There's a lot of information, there's examples that it takes you through, so I really encourage you to take a look at that website. Moving on to fringe benefits. So fringe benefits are taxable as compensation unless specifically excluded by the tax code. They're subject to federal withholding, Social Security, and Medicare. The employer elects the pay period to include the benefit as compensation, but it must be at least annually. You can either add it to regular wages or you can treat it as supplemental wages and withhold federal at 22%. Fringe benefits that are excluded under the tax code, and that's tax code 132, include de minimis or of little value. Some examples of this would be employee copy machine use, coffee and snacks, small holiday gifts, meal money when working overtime, where it's so administratively burdensome to try to account for these, that would fall under the de minimis rule. We also have employee discounts. So on services, the discount can't be more than 20%. And on merchandise, it's the gross profit percentage times the price charged to regular customers. Then we have no additional cost services. That's where the employer incurs no substantial additional cost in providing a service. So examples of that would be airline tickets for airline employees or train tickets for train employees, that type of thing. Then we also have the working condition fringe benefits. That's where property or services provided to an employee to perform his or her job. So you must meet the substantiation requirements there. And examples of that would be like business cell phone, company vehicle, that type of thing. A good reference for fringe benefits is on or IRS publication 15B. So they update that every year. It's out now. So if you need to take a look at anything in more detail, you can take a look at that. We have some benefits that are excluded by other code sections, which include accident and health benefits, except of course for the greater than 2% shareholder employee and some of highly compensated employee benefits. We have achievement awards up to the deductible amounts, which we'll talk about in a minute. We have the dependent care assistance, which is still $5,000 per year. We have group term life insurance, again, except for greater than 2% shareholders in S Corps. And then we also have the educational assistance benefit, which is $52.50 a year, $5,250 a year. And I wanted to just talk a little bit about a change in this that happened with the CARES Act. So the CARES Act and some of the extensions to the CARES Act allowed you to include student loan payments for both principal and interest to be included in this educational assistance benefit. The payments must be made after March of 2020 and it is extended through 2025. Remember, these are not taxable to the employee and it is deductible as an expense by the employer. You can either pay the lender directly or reimburse the employee. Also remember, it has to be non-discriminatory. You have to do this for everyone if you offer it. And you must have a written plan and give reasonable notification to your employees that you'll be doing this. This fell off a lot of people's radar because if you recall, there was a moratorium on student loan payments that started a couple of years ago, and they just started up again in September, I believe, of this year. So this is why it's really important to remember this and potentially offer it to your employees.
Mary Kay,
Yes.
on that educational assistance, what's the limitation or what's the maximum per year?
5,250.
Okay, thank you.
And that's for, tuition, fees, books, that type of thing, but
Mhm.
they did change it to add to, the student loan payments into that, which would be hugely valuable to a lot of people. So on to business expense reimbursements, you have two types. You have accountable and non-accountable. So with the accountable plans, it is tax-free to the employee, but you must meet 3 requirements. There has to be a business connection, which means the employee must have paid or incurred allowable business expenses while performing services as an employee. There's the substantiation requirement, which the employee must have a detailed report of the expense, including time and date, business purpose, and amount. Number 3 is you must return the unsubstantiated amounts, and they must be returned within a reasonable time. They must return any advances that are not substantiated, and payroll taxes must be withheld if not returned or substantiated. There are 2 safe harbors for meeting the reasonable time requirement. They include the fixed date and the periodic statement methods. For the fixed date, the expense must be substantiated by the employee within 60 days of being paid, and advances must be returned within 120 days of being paid. For the periodic statement, it's just like it sounds. The employer can issue a statement periodically of unsubstantiated amounts, and they must return the employee must return the excess amount within 120 days of the statement date. Also remember that per diem or mileage allowances are deemed substantiated up to the federal rates, which are announced each year. And we still, last time I looked, don't have the mileage rate, but that should be coming out very soon in the next couple weeks. These are some useful charts that you can take a look at and use as a reference. They are included on pages 29 and 30 in the booklet. Again, this chart is on page 31 in your booklet. So definitely use these when you're need to reference accounting and non-accounting plans. Oh, I think I forgot to talk about, let me go back to that. So for non-accountable plans, any business expense reimbursement that does not meet the qualifications of an accountable plan is subject to all federal taxes when paid and has to be reported on the W-2. Now we'll talk about limitations of certain business expense deductions. For business meals, unfortunately, it is back to the 50% deduction starting on January 1st of this year. If you recall, it was 100% deduction for the last 2 years, but that is no longer the case. It was not extended. Also, the entertainment is still non-deductible. And I did want to mention that this was a permanent fix with the Tax Cuts and Jobs Act a couple of years ago. This will, as far as I know, will not be returning. It's not going to sunset like many other provisions in 2025. So please keep that in mind. So travel expenses for dependents, they're allowed if they are an employee, if it's for a business purpose, and the expenses would otherwise be deductible. So if those 3 criteria are not met, it will be deductible if you include it in their compensation. So for moving expenses, again, this was part of the Tax Cuts and Jobs Act back in 2017. Moving expenses became includable in wages beginning in years 2018 to 2025. So this is something that could sunset. We just don't know yet. It'll be a little while till we know that again. It is not for U.S. Armed Forces, they still can be treated the old way. So you have to keep that in mind as well. The employer can still deduct the payment of moving expenses. However, you do have the employer taxes on it now. For Pennsylvania, you can exclude moving expense reimbursements from wages if a couple things happen. So the employees have to account to their employer all of the expenses. The expenses have to equal or exceed the reimbursement. The move has to be made for the benefit of the employer. It has to be a full-time position, and it has to be at least 35 miles further than where you used to live. If you simply reimburse for moving expenses in Pennsylvania, it will be subject to Pennsylvania withholding. For the Employee Achievement Awards, nothing has changed here. The employer can deduct the cost of an award up to $400 per employee. However, it is increased to $1,600 per employee if you have a qualified plan. So if you do have a qualified plan, it has to be written, it has to be permanent, and it cannot discriminate in favor of highly compensated employees. The award also has to meet tangible personal property definition. So it cannot be cash or cash equivalents, gift certificates, vacations, lodging, stocks and bonds, or other securities, nothing like that. Essentially, you have to think of it as, a watch, piece of jewelry, that type of thing. With that, I will turn it back over to Joe to do group term.
Great. Thank you, Mary Kay. Before I jump into the group term, so as Mary Kay mentioned, as we're working through payroll and payroll related issues, you have taxable fringe benefits to be looking at. Today is November 15th. We're down to about 6 weeks till the end of the year. So a lot of these fringe benefits have to be calculated and put into payroll as quickly as you can. So we would encourage you to begin working on that process sooner than later. As we go through some of these slides that I'm going to talk about next, we picked a couple of the more common fringe benefits to illustrate what you need to be looking at in terms of taxable fringe benefits. I will direct you to page 46 and 47 in the booklet. That will give you sort of a longer list of typical fringe benefits that employers provide to employees. But we may not necessarily touch on some of the other fringe benefits. But if you do have questions, you're encouraged to reach out to us. On the group term life, the value of the first $50,000 of group term life is a tax-free fringe benefit. The value in excess of $50,000 is a taxable benefit. So a lot of you participating in the webinar this afternoon have employer plans that provide in excess of $50,000. So there is a taxable fringe benefit that you need to be calculating. In addition, if you are an S corporation and you have 2% or greater shareholder employees, this benefit is not tax-free. It is taxable, and for that group, it's taxable based on the value of the premium that's actually being paid. There is no $50,000 tax-free benefit to them. It's taxable from $1. In order to calculate the group term taxable portion, there is a uniform premium table. We have it in your booklet for you. It hasn't changed in probably about 10 to 15 years. What I want to remind you of here is that this is a monthly benefit calculator, okay? It is calculating the taxable portion of insurance per $1,000 of excess benefit per month. So once you determine what 1 month is, you would have to multiply it by the number of months that individual participated in the plan. Another common fringe benefit out there is company-provided vehicles. Okay, the personal use of a company-provided vehicle is a taxable fringe benefit. The only way out is if it can be excluded if it's a working condition fringe benefit, or it's a de minimis benefit, or the vehicle they're using is what's referred to as a qualified non-personal use vehicle. An example of a qualified non-personal use vehicle would be a contractor, construction type vehicle that has all kinds of equipment on it. So the individuals take the vehicles home sort of as a way to keep that tools and everything from having to sit out in front of the employer location for an extended period. So those are the exceptions to personal use. So again, as we're coming up on the end of the year, we're going to look at what are the safe harbor methods to calculating that personal use. There are 3 of them. You have the commuting method, the cents per mile method, and the annual lease value method. The commuting method is probably the simplest of all 3. It's $1.50 per one-way, $3 a day. In order to use this method, you as the employer have to have a written policy prohibiting personal use other than commuting. In addition, you cannot use this method if the individual using the vehicle is a control employee. So be careful there. But as we're going through these methods, you can use either of these methods for any number of employees. So if you do have a commuting policy, you can use commuting method for everybody other than your control employees. If you then provide vehicles to your control employees, you're probably looking at a cents per mile method for them or the lease value method. Under the cents per mile, that again is using the IRS published cents per mile reimbursement rate for 2023, that's 65.5 cents. If you do not provide fuel for the vehicle, you can subtract 5.5 cents from that amount to calculate the personal use. If you can't use commuting or cents per mile, the default is to the lease value table. If you're using the lease value table, you have to use it for 4 consecutive years before you can revalue the fair market value of the vehicle under this method. You as the employer need to encourage the employees to maintain accurate records in terms of business personal use. They can use a representative sample if their pattern of use is regular and recurring on an ongoing basis. I would direct you to some of the information in the back of the book. We do have in the reference material beginning on page 139 through page 144, we have auto personal use documentation worksheets. So we encourage you again to take advantage of these worksheets. You can copy them right out of the booklet and hand them out to your employees. Again, on page 139, you'll see this employee representation regarding the company vehicle. This page will get everything you would need to use one of the 3 methods that I just referred to. It's going to get you the personal miles and the business mile breakdown. It will get you the number of round trip commuting trips. It will tell you if it's a control employee, and it will tell you if the employer is paying for fuel or not. So again, that one sheet will allow you to complete one of the 3 methods on the other 2 pages. So we encourage you to use these to calculate your personal use. Another taxable fringe benefit is for S corporations with your 2% or greater shareholder employees. And for this group of individuals, I referred to it in the group term life insurance. The fringe benefit is the actual amount of premium that you're actually paying for those individuals. And that would apply to all of the fringe benefits we're talking about here. So we're looking at accident and health, that would be your medical plan, disability insurance, workers' compensation premiums, and health savings account employer contributions. So remember, for that group, that you have to pick those up. There is a gross up formula if you find that when you include these fringe benefits in an employee's pay, you are going to reduce the net take-home pay by the amount of taxes that you are taking from those fringe benefits. You can gross it up if you're trying to include those taxes in the taxable value of your fringe benefit, but I would caution you that it's going to be a higher dollar amount by doing that. And again, you can discriminate among employees in using a gross up. So on page 71 in the materials, we're showing you a gross up using Pennsylvania tax rates where we have a $2,500 fringe benefit. It would gross up to $3,775. So the employer is going to pay an additional $1,275. Similar example in Maryland on page 85, using Maryland individual tax rates, so you could see what's happening there. So again, we would caution you when using those, make sure you're doing it with the approval of management when you're doing that. So as we come up on year end, you got to determine these fringe benefits. We put out by 12/15, but again, sooner than later. Gross up the fringe benefits if you need to. You have to deposit your payroll taxes in the payroll period. You have to update your payroll records, notify your service bureaus, and then make sure you're reconciling the W-2s and the 941s. So I'm now going to turn this over to Sherry. She's going to talk to us about information returns.
Thanks, Joe. 1099 information returns. So there's a broad amount of people who are required to file these types of returns. So basically anybody engaged in any trade or business making payments of $600 or more in any one calendar year for things such as services, rents, things of that nature are reportable transactions. So you must report payments of $600 or more in a calendar year made to any unincorporated entity, such as a partnership, an LLC, self-employed individuals. It's very much of a misconception at times for the LLC. A lot of people know that stands for limited liability company. A lot of people think that's an incorporated entity. It may or may not be. It really just depends, and we'll go over a little bit of that in the next slide. But keep in mind that your LLC entities can be any type of entity. They may be required to receive a 1099 or they may not be. Any legal service entity gets 1099 for $600 or more paid for legal services, and that is regardless of whether or not they are incorporated. So a lot of your law firms are incorporated. However, if you give them more than $600 in payments for services in a calendar year, they still receive a 1099 from you. Certain medical payments as well, regardless of incorporation, are required to be given a 1099. If you remember a few years ago, they came out with the 1099 NEC, which stands for non-employee compensation, where they essentially moved box 7 for non-employee compensation from the 1099 miscellaneous form over to a 1099 NEC form. They made it so that 3 forms fit on one page, and then you would file a separate 1096 for your 1099 NECs from your 1099 miscellaneous forms and any other type of 1099 form to get their own separate 1096. One of the reasons they did this here for the 1099 NECs, if you remember, is that there are different due dates for those. Essentially, they were trying to get some of the fraud under control, make sure that you both report both the recipient copy and the copy that goes to the IRS are both due January 31st each year. Unlike your miscellaneous forms where you can hold off on sending the copy that goes to the IRS until the end of March if you are an electronic filer. W-9 here on the next slide, there is a copy of this in your booklet. Just pointing out here that we have not received a new form W-9 since October of 2018. So if you go looking for that form and you think you have an outdated form, it is not outdated. October 2018 was the last time we updated the form. Really, partly they were updating this form quite a bit back around that time. What they were really trying to do, I think, is get the limited liability companies figured out. And I guess they finally did what they needed to do there. And so you will see there in box 3, if you're a limited liability company, you have to decide which type of entity you really are, since that is a check the box entity and can be treated very differently by various people. They can also make this election every year. So if you are an LLC, you probably know that if you have one owner, your default is as a sole proprietorship. You have 2 owners or more, you're a partnership by default. However, you can make an election to be treated like a corporation and then choose the further elect S status for your corporation. So as you see there in box 3, if you are an LLC, you would need to figure out which type of entity you have chosen to be. So I will also caution that if you have LLCs that you pay payments to that qualify as a service or a rent or some sort of nature that you need to give them a 1099, make sure you're getting that W-9 annually from them, because the LLC can, in March of each calendar year, make that election. So you could be a partnership for several years and then choose to make the election March of that year to go into effect. So it is a good idea to get those updated each year from your vendors, and also how you would fill this out for yourself if you are an LLC. Again, if they choose S status or C corporation status and they check that box, then you do not need to give that vendor the 1099. And I will also say that if you are making that election and you're previously a sole proprietor, make sure you take a look at those 1099s when you receive them, because a lot of people don't update their system and they may send you a 1099 under your social security number, which would then be incorrect and would need to either be corrected by them, or you will want to make some changes to your tax return. So make sure your tax service provider receives those 1099s if you were to receive any in that year of change to the wrong place. Form miscellaneous, 1099 miscellaneous, again, those are due to the recipient and paper format to the IRS on January 31st, 2024. Those are due to the IRS on April 1st, 2024, if you're e-filing those 1099s. Again, now it's usually March 31st, falls on a Sunday this year, so it's April 1st. You still have to get the forms out to the recipient January 31st. So I would say that you might want to hold off sending to the IRS for a little bit. I wouldn't say necessarily wait until April 1st to do it, but you might want to hold back a little bit to make sure there's no corrections, which would make it just a little easier for you to do if you can do that before you e-file with the IRS. So Form 1099 NEC, once again, January 31st is the deadline, whether you paper file or e-file, and sending those to both the recipient and to the IRS. You can get a 30-day extension, can be requested in writing by using Form 8809. However, it's very limited on when those will be granted, and they're really only granted in extraordinary circumstances or such a catastrophe. All other types of 1099s can still be filed with the IRS by February 28th if you're paper filing, and March 31st if you're filing electronically. Just pointing out that they did change the 1099 miscellaneous form in 2022. They no longer update this form every year. They came out with the NEC form, which was the same method, where now it's just a fill-in for the calendar year that you're filing for. And then just to go over really quick here, rents, box 1 would be anybody that you make rental payments to, just to like for your office space or storage rentals. If you pay rent to a real estate agent or to a property manager, keep in mind that you would not include rents to those individuals on the 1099 miscellaneous. Instead, the property manager or real estate agent will create a 1099 for the property owner. So that's one exclusion for if you pay rents to, again, a real estate agent or property manager. Another item on here to point out for exclusions would be the C and S corporations. Again, you'll get that information on their W-9, so that's how you will know that. Another exclusion would be if you are purchasing your services, paying for your services with a credit card or a third-party vendor. Let's see if I have a slide about this. I don't think I do. So a third-party vendor would be something like PayPal or Venmo, that type of vendor, third-party vendor, payer. Payments made by those type of entities or by the credit card merchants are reported to your vendors on their 1099-K form that they're providing then to the ultimate recipient. So you do not include those payments, and it is important that you exclude them, because remember that this is information for matching for the IRS. So if they get all those payments reported to them on a 1099-K, and then you turn around and we report them on a 1099 NEC or miscellaneous form, then that's duplicating the amount of revenue that the IRS is going to expect for them to be reporting on their business tax return. So while it might not be a big deal for cash, people who get a lot of cash revenue, that can be a very big deal to some of your small contractors who may get 1099s for the majority of the work that they do. So it can cause a big matching issue and a problem for them. So somebody yesterday in our live seminar asked me about how they would pick and choose that. A lot of your and track how those payments were made. I'm going to say that most of your accounting software should probably have a way to pull out different type of transactions when you're searching for the payments that need to be included on your 1099s. A lot of your accounting software also will help track these vendors. So there's normally some sort of checkbox or some way to tell your accounting system that this could be a 1099 recipient. If they are providing services, again, think people that you pay for repairs and maintenance, rents, professional services, and in your contract expenses. Electronic filing, this is the big new thing this year. If you remember in the past, you had a pretty generous filing requirement, limitation or threshold to meet before you had to e-file your tax returns with the IRS for 1099s. That used to be 250 for each type of 1099 or information return that you filed. So you could have 200 1099 miscellaneous, 200 1099 NECs, 100 employees filing W-2s, and you were not required to e-file those forms with the IRS. That has changed quite a bit this year. It is now a reporting requirement threshold at 10 forms, and that is aggregated. So you can have 9 employees and 1 1099 NEC, and you are going to be required to e-file that one form 1099 NEC. So big change. So anybody who is currently paper filing their 1099 forms with the IRS, just be aware that you very likely have an e-filing requirement for the first time this year. And keep in mind that if you kind of mess this up and you send in the paper forms, those are considered not filed at all, and therefore subject to penalties for non-filing, which we'll get to in a little bit. But in order to get everybody on board with this, the IRS does have a new free portal for businesses. It is called IRIS, or let's see, it's called the, which stands for Information Returns Intake System. So it's free to register and to use. So you can file for free by this system that they set up. You would go to, I have the link here in your slides for the application, but if you go to the irs.gov website and type in the search bar IRIS, it will take you to the page that has all of the information necessary for applying for this new portal. So again, this is mandatory for 2023 forms that are going to be filed in January. So if you are someone who has historically paper filed your 1099s, I would encourage you to get started on this process. It is available for you in your booklets. We have provided for you, starting on page 101, all of the various information that is also on the website, but it gives you an overview of the system, how everything looks, how it's transmitted, how you access the application. You first have to go in and apply for a TCC code. Once you get that code, you will then apply for the actual portal access, and you'll use that code to do that. There is a list in your booklet of those things that you need to have available for different people who would be the applicant and the authorized users of the portal. So there are various different things that you will need for each one of those people before you go through the process. So I encourage you to look at pages 101 and that goes all the way through page 110 of your booklet, giving you screenshots of what to expect throughout the application process. And here's why it's really very important that you do it. Like I said before, if you file these by paper and you were indeed required to e-file, it is considered non-filing and you would be subject to penalties. And you can see how they've escalated those penalties. This is same shot as I had from last year, but I just needed to point out how they have escalated over the years. For 2023, any returns up to 30 days late, $50 per return. And this is per return to the IRS copy, double it for the recipient. So it's not just one per 1099 per se, it's per copy. So 31 days late through August, $110 per 1099. After August 1st or not filed, $290. And then the total that you can actually be charged in total goes up to $556,000 per year. And that is pretty astronomical for just not filing 1099. So I will tell you too that the IRS does, ever since they started putting that question on our income tax returns, I'm not sure if you've noticed this question, but it's on every single tax filing that we prepare, whether you're a Schedule C sole proprietor, Schedule E rental business, or partnership, S Corp, every single type of return, there is now a question that says, hey, did you file, are you required to file any 1099s with the IRS, yes or no? And if you say yes, have you filed all of those 1099s? So in every single audit that I've had come up since then, they will ask you for general ledger detail of certain accounts. Usually your repairs accounts are big ones, any kind of service. And they will go through that and they will give you a list and ask you for your 1099s. And they will ask you why you didn't file a 1099 for somebody that they think you should have. Very good way to combat that as well is to make sure you have those W-9s filled out by your vendors. Make sure you have those on hand, because if you can simply say, well, 1099 or the W-9 says they're incorporated, I didn't send it to them for that, check the box, you're done. And the question goes away. So make sure you have those on hand. You will use a copy of the federal 1099 miscellaneous or 1099 NEC when you are filing with Pennsylvania. Federal Form 1096, though, is not required. If you file 10 or more 1099s, you must file through MyPath. I think Abbie mentioned this a little bit earlier, but just another reminder, the 2023 forms are due to Pennsylvania by January 31st, 2024. I think Abbie went over this a little bit earlier as well, but just another reminder that a few years ago, if you have Pennsylvania non-residents, individuals who should be getting 1099s from you and you're a Pennsylvania business, you are required to withhold Pennsylvania tax withholding from them if you pay them more than $5,000 or more in 1 year to a non-resident. Those withholdings are paid electronically through MyPath and are required to be filing quarterly withholding returns and annual reconciliations. I would recommend that in our booklet on page 209, 210 is Form Rev 1832. This is an exemption form, so it's not a bad idea, I don't think, to have this filled out by all your vendors right along with that W-9 if they're a non-resident, and let them check the boxes that would exclude them from this withholding requirement. Maryland 1099 reporting. They participate in the federal combined reporting program, so you really typically do not need to send any 1099s to Maryland separately. They participate with federal. PA is unlike that. They do not participate with a lot of things federal. So the federal 1099 miscellaneous and 1099 NEC only needs to be submitted directly to Maryland if there is Maryland state withholding. I think you'd probably only see that if you have a backup withholding requirement. So you don't see this very often, but if you do, Maryland state withholding would get submitted with the Maryland MW 508, like individual income tax withholding on your payroll, and you would submit 25 or more of those, which is very uncommon. But if you would, you'd submit those using the Maryland SFTP system, which is something you have to pre-register for. So if you would foresee that in your future, that would be something you want to do in advance. But again, very uncommon to have to do that.
Yeah, Sherry, excuse me, before you jump into the next slide, can you clarify on that electronic filing for 10 or more forms?
Yep.
So your example was 9 employees with a W-2, 1 1099. Are all of those forms required to go electronically?
They are.
Okay.
Yes. And I would even go for, like, for example, I was in a CPA just recently on partnership returns and found out there's still a lot of small partnerships that paper file with the IRS. And this is also one of the types of returns that they said, you know, if you get caught up in this e-filing requirement for aggregate returns, that partnership return counts too.
Okay.
So so they were mandated actually under legislation a couple of years ago to start to require more and more e-filing at the IRS, and this was one of the ways that they did that. Yeah.
Thank you.
Information return compliance issues. One of the big things we get asked about every year is whether or not somebody is a contractor or an employee. So a couple of quick tests to determine that. The Department of Labor has a 6-factor test. They had tried to change that some years ago, but it's a little bit more detailed, but we usually look very broadly at the 3-prong test that the IRS has out there, which includes a behavioral control test, which evaluates whether you have the right to direct and control how work is being done by your worker. different things like how detailed of a training do you give them? Do you tell them that they have to do something a specific way? Do they provide their own equipment, or do you tell them what they have to use? Do you give them everything for that? Financial control considers whether you have the right to direct and control the economic aspects of their work. For example, do they have to, are they allowed to go out and hire another subcontractor to do some of the work that you have asked them to do? And therefore, have work with multiple different companies. So they may, do you restrict them to only do work for you? Do you have them working so much for you that they can't work for anybody else, right? If that's the case, then they might be an employee. The type of relationship. How do each of you feel about the relationship? Do you both consider the worker to be a contractor, where again, they can go out and they can do work for other people and for you, and kind of do it at their own free will, making the amount of profit that they want to make on that relationship? Or are you providing benefits for them? They expecting benefits from you? That type of employee benefit that, a lot of things we talked about earlier and Mary Kay touched on. Are you providing those types of benefits? And then they very well may be an employee. It is important that when you're talking about this, I've had so many discussions with clients about this situation over the years. And it is very important that you understand that just because they might be considered an employee, like one little thing in there does not cause them to be an employee. It's a overall facts and circumstance test. These are just 3 major guidelines that you want to look at that help you make that determination. The IRS does have a voluntary classification settlement program available where you file form SS8. Now, either the employer or the employee or contractor can file this form with the IRS and give them, it asks a lot of questions about the relationship under these 3 types of tests, and it lets the IRS determine how they think they should be treated. So that is an option. Backup withholding, if you have somebody who will not, just kind of goes back to the W-9 and whether or not they provide it to you. If you request a W-9 and they do not, that W-9 is really like, not only does it give you the information about what type of entity they are and whether or not they should get a 1099, you are also certifying that they are not required to have backup withholding. There's a little checkbox on there where they're saying that. So that W-9 is what allows you not to do backup withholding. If you do not get a W-9 from that vendor, there's nothing saying that you aren't required to withhold backup withholding. So you should be withholding 24% and then remitting that to the IRS. Another way that comes up, sometimes you get these B notices, which I believe that Abbie and LuEllen talked about earlier today, which is a mismatch in the EIN or the Social Security number that was reported on the 1099, and then requiring backup withholding if you can't resolve that issue. Again, reminder that October 2018 was the last time the W-9 was actually revamped. So that's all I think I have. Joe, turn it back over to you for the comprehensive.
One other thing, Sherry, and I think you mentioned it yesterday in the in-person seminar.
Yep.
When we're talking about, 1099s being issued to individuals who don't feel that they are truly independent.
Yes.
You want to talk about that just real quick?
So if you have, if you give a 1099 to somebody and they don't feel that they should be treated as a contractor, and this is why it's really important that you figure this out up front, they can then request that the IRS, they can fill out that SS8 and they can submit that to the IRS, and then, the IRS would come back and then come after you for payroll taxes. So that's something that's very important for you to consider if you're kind of borderline. Make sure that you and your worker are on the same page.
Good. Thanks, Sherry. Okay, on to the comprehensive example. So on page 52 and 53 in your booklet is where we have the comprehensive example. Again, not a lot changing in terms of the W-2 itself from 22 to 23. On page 52, we give you a comprehensive example of a hypothetical employee. What we're showing you here is, they're getting paid a set amount bi-weekly, but when we go to include the taxable fringe benefits in pay, you can see on page 52 what effect that may have on net take-home pay. So in our example, we're including $1,844.50 in compensation as taxable fringe benefits. So the normal take-home pay was $3,931. Once we ran that through payroll, the take-home pay was $3,529. So that shows you what happens if we're including them and additional taxes are coming out. From this information, we then move to page 53 where we have the W-2 for you. So again, not a whole lot changing on the form itself. We do remind you that on box 13, make sure to check a box here if you do have a retirement plan. Box 12A is for a number of predetermined benefits that are being provided. The DD is for group health insurance, but I believe that's for 250 or more employee head count. That's a requirement. We're just doing it here for illustration purposes. The D is for a 401k deferrals. The C coding is for group term life insurance. So box 12 has certain pre-coded information that's required. Box 14, you can put anything you want in box 14 that you feel you want to share with the employee. If we have 2% or greater shareholders and shareholder employees, box 14, you could put that fringe benefit amount in there for health insurance and other taxable fringe benefits there. Down at the bottom on page 16 or line 16 and line 18 is your state and local wage. This is for Pennsylvania employers. That number typically is the same for your employees. So as you're looking down through your W-2s before you get ready to send them out to your employees, you can double check there that those amounts are the same. Before we get into the beneficial ownership, also just to be aware, we did put a lot of information into this booklet, not only the text of what we were talking about today, but a lot of federal and state resources in the booklet. So we encourage you to look through the booklet, make copies of forms that you need to use based on what we put in here. But in addition, just some of the reference material, again, www.irs.gov is a great place to be looking for government publications, specifically the W-9. That hasn't been updated since 2018, as Sherry was saying. So that could be a form that will get an update here in possibly 23, 24. So with that, I will turn it over to Mary Kay, who's going to talk to us about this beneficial ownership reporting.
Thank you, Joe. So we wanted to touch on this today. BSSF did send out a blog last week If you haven't seen it, we do have it on our website. And we've also included the information on page 60, or starting on page 60 of the booklet. So this is going to be a new filing requirement for certain entities beginning on January 1st, 2024. It was part of the Corporate Transparency Act that was enacted in 2021, and it was to combat fraud, money laundering, and other illegal activities and financial crimes. So the reporting will be done through FinCEN, which stands for Financial Crimes Enforcement Network. So for existing entities, the due date is going to be January 1st, 2025. For entities created after December 31st, 2023, you will have 30 days to file this. Now, I do have asterisks here because they're hoping to change this to 90 days instead of 30, but we don't have anything final on that. So we'll have to update you on that. Changes or inaccuracies have to be filed within 30 days of those changes. So there are going to be some exemptions from filing this, and one of them is large operating entities. So if you have more than 20 employees, that's US employees. If your gross revenue is more than 5 million on your prior year tax return, and you have a physical office in the United States, you will be exempt from filing. Another exemption are publicly traded companies that are registered with SOX, because obviously there's already information out there on these companies, so there's no need to register. This is more for private companies. So there's other exemptions, and there's 23 on the FinCEN website. The main ones that would apply to most of our viewers today would include governmental authorities, banks, tax-exempt entities, insurance companies, etc. So the information you'll need to file this includes the full legal name of the reporting company, and that includes any trade or DBA, the business address, the state of formation or registration, the tax ID, and then also the beneficial owner information. So who is considered a beneficial owner? That would be someone who could exercise substantial control. An example would be a president, CFO, CEO, general counsel, or an owner who owns 25% more of the equity interests. Well, let me go back. So information required for the beneficial owner includes name, the date of birth, address, driver's license or passport. It has to have an image. So the good news here is that at this time, they're not requiring social security numbers of beneficial owners, which I know a lot of people are concerned about with, stealing identities. So at this time, they're not requiring that. So for companies that are created after 1/1/24, you have to have a company applicant. So a company applicant would be somebody like an individual who files the document that creates the entity, and the individual who is primarily responsible for directing and controlling the filing. There are penalties for this. If you don't comply, it's up to $500 per day for civil, and then potentially a $10,000 fine and imprisonment if there's criminal activity. So the talk right now in some of my classes that I've been in is that this may be something that attorneys will file for you. We don't know if CPAs are going to be allowed to do it because it could be considered unauthorized practice of law. So we have to get more updates on that. and we may have to get guidance from our state legislature on this. So we will be following up with you on this. Again, you do not have to panic about this. It's, you'll have 1 year to file starting in 2024. Please do not try to look for this right now because you might be seeing something that's fraudulent. We are hearing reports of fraud already with this, either by mail or email. If you're getting something, from some obscure entity, please do not give them any information. Nothing is out yet regarding this. You cannot get on the website. I'll be surprised if you can get on the website at January 1st, but we'll see what happens. These types of things take longer than they initially say. So again, we will be putting out more information on this either through email or, you could always go to our website and look for it. Potentially, you could be getting information from your attorney. So you should only, be using that guidance from us or attorneys regarding this. So please be aware of that. I will hand it back over to Joe to wrap us up here.
Thanks, Mary Kay. I would say to that as well, it's relatively new. In addition, we probably will be putting out updates to other items that were in our handout material that we didn't have a final number on, and one of those would be the mileage rate that the IRS publishes. That rate for 2024 hasn't been published yet, but we do expect it probably in the next week or two. So anything related to the materials we're talking about today, if there's a subsequent update, we will email out to you what those updates are as we receive them. And with that, we have Q&A for session 2. Kayla?
All right, so I'll start with, does the large employer exemption apply to the entire affiliated group? For instance, a holding co-parent with no employees and little activity.
Is this for the beneficial ownership?
I would think it probably is.
Okay, so that we don't know yet. My guess would be that if there's ownership of separate entities, I would think you may, if it's under the 20, I think you may have to fill out this information, but again, we don't have those details. I actually tried to search for that myself and didn't really find anything on that, so we'll have to keep our ears open for that information. Again, we will be providing information, I'm sure, through our website, or even reach out to your BSSF advisor. They'll have that information.
How often should a company request a new W-9 from vendors?
I would suggest that you do that at least annually, probably before you send them their first payment at the beginning of the year. Although I would say they have until March to make that election for an LLC. So, before the end of every year, maybe collect a new W-9, but at least annually.
What would be an example of a medical and healthcare payment that would go in box 6 on the 1099 miscellaneous?
Box 6. Yeah. I have the instructions right here. Oh, the medical payment. You will usually, I've usually seen this for like a medical provider. It's payments normally come from an insurance company that they will provide these 1099s. Sometimes it is very important if you are a medical service provider and you get these 1099s from your insurance company, you will want to make sure that you give, if they request a W-9 from you, from your partnership or whatever, that you absolutely fill out that W-9, because I have seen clients who have gotten into trouble with this, and then they end up getting backup withholding for their insurance payments, and then having to get that back from the IRS via credits to their owners. So it can become a big problem if you do not fill out those W-9s. If you receive one yourself, as a service provider, fill them out. Just make sure you're doing that. That's normally where I've seen the box 6 payments.
If audited, what is the penalty for not filing a 1099 NEC?
It's on the slide deck there. It's the same thing as all the other 1099s. It depends on how late you file them or not file them. Was it like
It's 580.
it's 580 if you double, because you double it, because it's for 290 per copy. So per 1099 you get a recipient. Assuming you didn't send to the recipient or to the IRS, then it's 580 per 1099 NEC or miscellaneous. Same concept.
Yeah, and just to piggyback that with what Sherry's saying is we are seeing an increased volume of the IRS assessing penalties on 1099 filings. So in the past, it's always been there, but I believe the IRS was a little more passive in how they were looking at that. But post-COVID, they're beginning to get policies and procedures in place to assess those penalties. And you may be seeing an increased volume of penalties being issued in 1099 reporting going forward. So again, make sure you're getting W-9s, make sure you've got policies and procedures in place to determine who's to get those 1099s, and you're getting them filed in a timely manner.
Yeah, because remember, they're going after them because all these increased penalties were put in place in legislation to pay for something, right? So if we got some sort of tax break in a tax law, it was very common for multiple years in a row there, where they were just increasing the non-filing penalties on the 1099s. So now we're starting to see them come after it.
Yeah.
Next question is, will the beneficial ownership reporting apply to most real estate entities?
Sure, yeah, they're not specifically exempt that I've seen. So if you're not a large real estate entity, yeah, that will probably have to be filed.
And the last question that I'm seeing right now is, can we reimburse Social Security Part B insurance, show that as a fringe benefit, and then deduct it on the personal return?
Well, that depends on, because I mean, you're not deducting that on a personal return most of the time for an individual.
Yeah, I think I would say it's probably grouped in with the health insurance, as long as you're including it in payroll, you should be okay. And you can probably identify it in box 14 as to what you were reimbursing and whether the individual can deduct that will be determined at the individual level. But it would seem to me that it would be a taxable fringe benefit. You would have to include it, subjected to whatever federal and state taxes that would be subject to, and probably identify it in box 14.
Yeah, there was some when the Affordable Care Act came out, there was some limitation for that in some gray areas where you had to, like, you couldn't show it as a reimbursed expense. And you just had to increase wages, taxable wages by some amount. But I do think they've come out with clarification on that, but it's still taxable. And then it would, again, like you said, be determined. Now, if it's an S Corp owner, their Medicare payments are considered self-employed health insurance. So that would be a deduction.
That's all the questions.
That was all the questions. Okay, I think we're at the end. Kayla, are there forms that need to be completed for the individuals attending?
So when this session closes, a survey will come up on your screen inviting you to give your feedback, which we would greatly appreciate, so we can continue improving this year over year. Otherwise, no, that is it. I will be sending out an email to everyone with a link to the booklet, the PowerPoint, and the recording of today's session by the end of the week.
Great. Well, thank you, everybody, for attending today's webinar. We look forward to seeing you as tax season's coming upon us. And again, feel free to reach out to any of us that have participated in today's webinar. If there are questions, feel free to send us an email or give us a phone call. We're happy to talk to you to answer any questions you might have. Thanks again for attending, and we look forward to seeing you soon.